Exercise 1. Use the March 31st fiscal year-end information from the following ledger accounts. Assume that all accounts have normal balances to prepare closing journal entries. Well, let's first talk about closing entries. The purpose of closing entries is to transfer dollars from the temporary equity accounts, revenues, expenses, and withdrawals, into the permanent equity account, the capital account. We've already seen this process when we prepared the financial statements. Remember when we talked about financial statement dominoes? The income statement reports revenues and expenses. Revenues and expenses are netted together in the calculation of net income. The answer from the income statement is transferred to the statement of owner's equity. The statement of owner's equity shows the change in total equity, including the owner's investments, net income, less any withdrawals by the owner. The ending capital balance appears on the balance sheet. The closing entry process parallels this flow exactly. We'll start with the income statement accounts. First, we'll close the revenues to income summary. Income summary is a temporary equity account. After we've closed the revenues to income summary, we'll close the expenses to income summary. The income statement nets the revenues and expenses together in the calculation of net income or net loss. Income summary achieves the same goal. The answer from the income statement, which is now in the income summary account, will then be transferred to the owner's capital account. And finally, the withdrawals will be subtracted from capital. So let's look at the closing entries for exercise 1. Each of the accounts listed here is a subset of equity. The capital account is the permanent equity account. The revenues, expense, withdrawal accounts are all temporary equity accounts. And we're going to start, just like we did on the income statement, with our revenues. Revenues have normal credit balances, as their purpose is to increase equity. So to close a credit balance in the revenue account, we will debit service revenue for its balance $91,624 and transfer the dollars to income summary, crediting income summary for $91,624. The next step is to close expenses to income summary. Expenses decrease equity, which is why they all have normal debit balances. So to close the expenses, we'll credit the expense accounts. For this company, the expenses include depreciation expense $21,000, salaries expense $26,000, insurance expense $5,460, and rent expense $11,520. By crediting each of these expense accounts, we drop the balance in those accounts to zero. And to balance our journal entry, we debit income summary. $63,980 is the same number that you would see on the income statement as total expenses. Net income in the current period is $27,644. The balance in income summary is transferred to capital, debit income summary, and credit the owner's capital account. And the final step is to close the balance in the withdrawal account. The owner has withdrawn $56,744 in the current period. The withdrawal account has a normal debit balance. To close the withdrawal account, we debit the owner's capital account and credit the owner's withdrawal account. Requirement 2 asks us to post the above entries to the respective ledger accounts. Service revenue began with a credit balance, a normal balance of $91,624. This closing entry debits the revenue account and credits income summary. Service revenue now has a zero balance. The second closing entry closed the expense accounts to income summary. We had 4 different expense accounts, each of which had a normal debit balance. To close these accounts, we credit depreciation expense, credit insurance expense, credit salaries expense, and credit rent expense. Total debits to income summary $63,980. At this point in time, the balance in income summary, $91,624 in credits, $63,980 in debits, is a net credit balance of $27,644. Remember that income summary is an owner's equity account and follows the same rules as equity. Credits increase owner's equity, so when we see income summary with a credit balance, it's increasing equity, which means it must have been net income, not net loss. After this journal entry, the balance in all of the individual expense accounts is 0. The next journal entry transfers the balance in income summary to the owner's capital account. We saw this on the statement of owner's equity when we added net income to the owner's capital balance. The journal entry debits income summary and credits the owner's capital account. The balance in income summary after this third closing entry will always be 0. Cruise's capital balance has a subtotal of $79,644. And the final closing entry closed the withdrawal account to capital. The withdrawal account had a normal debit balance, so to close that account, we debited the owner's capital account and credited the withdrawal account. The balance in the withdrawal account is now 0. And Cruise's capital balance is a credit balance of $22,900. When we look at the capital T account, we're really looking at the statement of owner's equity. Beginning capital, $52,000, plus net income, $27,644, gives us a subtotal of $79,644, less the owner's withdrawals, $56,744, is an ending capital balance of $22,900.